delighted to be joined by Natalie Goldstein and Migla Kosmeta, who is actually not visible at the moment, but is with us from My Expat Taxes, Chris Baker from More DM, and Caitlin Meinert from Bright Tax US Expat Tax Services. This session is a Meet the US Expat Tax Experts panel session, and we're also joined for the session by Karen Dess from Anglo Info, the conference sponsor. In this session, Karen and I will be putting your questions to the US tax experts, so please start asking your questions in the Q&A box at the foot of your screen, as I know some of you already have, and we'll get through as many as we can. To begin with, though, I'm going to ask our tax experts to introduce themselves and their firms. Before we dive in, though, please bear in mind that the information presented is for general educational purposes only, and you should always seek your own personalized financial advice. So, Natalie, would you like to start?
Yeah, sure. Hi, everyone. I'm Natalie. You heard the chit chat in the beginning. I'm from California, where I like my sunshine. Now I'm in Vienna, Austria, where I don't get that much sunshine, but it's okay. I, am through it with you. I'm an expat. I have to file US taxes. And I found the process very frustrating. So I created My Expat Taxes, which is the leading US expat tax software. So you can do it yourself with our platform. You can always look to have a tax professional look over your tax return, or you can even opt to have a video call with a tax professional and basically have a tax professional lead you through the whole process. So whatever your situation is, simple, complex, you need a bit more help, you need less help, you can find it all with My Expat Taxes. I'm joined with Migla, who is not visible, but she's one of our tax professionals, so she'll help with the Q&A as well. And that's me, that's us.
Chris, over to you.
Hello, everyone. Yes, my name's Chris Baker. I'm a director here at Moore Doran Mayhew Limited in London. So I've pulled the blind to show off my grey hair. I think it's accentuating it. So it's dark outside over here. Moore Doran Mayhew, our parent firm is Doran Mayhew, large firm in Michigan. There's an expat team there in Troy. We're in London and we're in Zurich as well. And we deal exclusively with US tax, but within the Moore network that we're a part of, we have UK firms that we work with in London. The Swiss team have Zurich, Geneva, and actually quite a lot of Frankfurt contacts. So we plug into the local systems. We deal with the US, all aspects of that from here.
Thank you, Chris. Over to you, Caitlin.
Thanks, Hugo. My name is Caitlin Meinert. I'm the CEO of Bright Tax, which is a cloud-based tax preparation firm for American expats. We've been doing this for more than a decade now, and we offer a CPA relationship for American expats around the globe. I am based actually in the US now after living a decade in South America between Chile and Brazil. And looking forward to relaunching my expat adventure with my family here soon. But that's all for me.
Thank you. Karen, would you like to say something about Anglo Info?
Yeah, I think I got it all wrong in the first session when I was a panelist with you, because nobody understood what I did. So I'll be much slower. I think it has to do with the South African accent. Anglo Info is a website for expats who live and work overseas. We have 60 sites in 90 sites, I beg your pardon, in 30 different countries, and we have 10 million page views a year. So that makes a really good vector for people who want to reach that market. But more especially, it means that a lot of expats use us to find their way. And that's really very important for us to be useful to people who are finding their way. And the last 3 days on this conference, because I have attended quite a number of sessions, has made it clear to me how complicated it is to be a US citizen and an expat. It seems to me way more complicated than anything I have encountered as a South African in Kenya, in Mauritius, and now in France. That's me.
Thank you, Karen. Before we dive into our audience questions, we had a session yesterday in which we discussed the US's citizenship-based taxation system. And I wanted to get a perspective from our tax experts on the panel this evening, whether they think CBT and FATCA will ever be changed. So if possible, would our three tax experts be so kind as to briefly give your opinion on this question? Chris, would you like to go first this time?
Yeah, I would be of the view that I see it as a very unlikely development. There are lobby groups in the foreign space, and just for clarity, when I say foreign, I mean non-US. We'll look at it from the way that the IRS and the US government view the world, as aliens sat outside in my case. So you have the lobby groups, but they're a very small piece when it comes to what's going on in Washington. And I mean, when the old offshore voluntary disclosure programs all came in back in the day, again, others may have a different opinion, but they weren't aimed at these accidental Americans sitting in foreign countries. They were aimed at the people who had the UBS accounts that they hadn't been reporting. So there were punitive penalties on those schemes. And then those schemes got overwhelmed by people paying their taxes abroad, didn't really owe anything to the US. And all these other returns came in, which I think is essentially why the Streamline program came in. They weren't that I think they were surprised by how many, and then when revenue's coming in, governments rather like that, would be my view. So
yeah, thank you. Caitlin, what about you?
Sure. Well, I suppose first I'll say that if I was any good at predicting the future, I probably wouldn't be here in tax accounting. I'd be day trading, right? And and using my abilities to predict the future that way. And yet I think because of the amount of investment that's already occurred, both on the US side and the foreign side in FATCA, as well as what Chris referred to as, a source of revenue for the government that doesn't have a significant amount of representation, it's probably unlikely that at least anytime in the next couple of years we'll see movement on this. Where I think we may see movement, though, is perhaps the simplification of the U.S. tax system and the filing process for Americans abroad. And if something were to change where the filing exercise were to become more simple for those living outside of the U.S., there would probably still be some paperwork required. And yet, in working with Americans all over the globe, I've observed just how simple other systems and tax system filing processes are. So knowing that the IRS is slowly but surely moving in the direction of offering an improved taxpayer experience, that would be my expectation of what might happen next to at least improve the experience for a U.S. taxpayer living outside of the U.S.
That's great. And that would make a huge difference to millions of people if it was the process was simplified or streamlined somehow. Natalie, what about you?
Yeah, I would probably err on the side of not having much changes happening there with citizen-based taxation. I mean, the IRS knows that there is, taxation of US Americans abroad. And I feel like their response has kind of been like, well, with the foreign earned income exclusion and the foreign tax credit, you're not really paying taxes. So what's the problem with filing? I feel like that's the general response, so to say. And then on top of that, it was just in the recent years that when they were kind of putting out their new topics of focus, expats was one of them, that they want to focus more to make sure that expats were filing. So that just happened recently, that they wanted more attention on those living overseas. So because they just released that, I doubt that they would be closing citizen-based taxation anytime soon. And with FATCA, I mean, that is really kind of to prevent money laundering. And obviously that is kind of more for, people with the big bank accounts that are doing that. But obviously we've seen in the past year and stuff, the FATCA files that have come out and, they've proven useful. So I doubt that they would close that program, because even though it affects millions, and it shouldn't really affect millions, they see the benefit because they catch the people they want to catch at the end. So at least that's my opinion. obviously, as an expat filing from abroad, I wish it were different. However, I do hope that it is simplified. I don't think it'll go away, but I hope it will be simplified.
Thank you all very much. So look, we've got lots and lots of great questions for coming. Karen, shall I kick it off?
Yeah, please do.
The first one's something of a tongue twister. Okay. Is direct non-interest bearing debt, Chris, do you want to feel this? Is direct non-interest bearing debt held through a financial institution and not held for investment? It's just a complex one, with full principal unlikely to ever be repaid, owed by a foreign individual or a foreign company? I'm not sure this is one. Shall I keep going? It's
is it there to be? I mean, yeah, crack on.
Are you following so far? I was wondering, it's the sort of thing, if you saw written down, might be more comprehensible, but okay, I'll keep going. So non-interest bearing debt, not held through a financial institution, not held for investment, with full principal unlikely to ever be repaid, owed by a foreign individual or foreign company, not over 50% ownership, US ownership, to a US person, reportable anywhere as a US expat.
So if I've understood that correctly, a US person has lent their friend money. So that like itself is not a problem. And the friend is not going to repay that. Essentially, if you're already saying that at this stage, then you've probably made a gift. So I think you've probably got gift tax reporting rather than anything else. Forgiveness of a debt is income, but that would be to the foreign person. We're not advising the foreign person. They probably haven't got a US issue there, but I would focus in that you have a gift, and if it's over, I mean, please correct me if I'm wrong, anyone, but I think we're now at $17,000 per person for 2023, up from what has been 16,000 that you can lend, you can gift to any individual, any number of any individuals, as many $17,000 as you like. But once you're over that, you're filing a gift tax return. And I think when you have a loan that you do not expect to be repaid, then you've made a gift.
Thank you. Karen, do you want to read another question?
Can the panel, excuse me, you speak English. Can the panelists talk in more detail about the carryback rule for foreign tax credit? What if we weren't living abroad in the prior tax year? Does the carryback rule still apply? I'm not quite sure who I need to ask to answer this.
I can grab it. I mean, the carryback rule is not necessarily for your prior year of taxes. The carryback rule is saying really that you can, so if you pay taxes, so for example, in 2023, you can carry that back to claim on your 2022 tax return, right? Because obviously you're in a different tax year. So normally it's 1 year carry back. The thing is, when you use foreign tax credits, you don't have to necessarily be living abroad to use foreign tax credits, right? You just have to have foreign income to offset it. So if you are amending a prior year return to do a carryback as well, you could do that. You have to live abroad. You just have to have foreign income, to offset with foreign taxes. You can't use foreign tax credit against US income. So that would be probably the major concern. If you're not living abroad, you probably don't have foreign income. And if you have no foreign income, you can't use foreign tax credit. But essentially, you can carry back 1 year. I normally see it more of a practice of people carrying. So, you're paying taxes in the current year and you carry back to your current year tax return because you just, need a little bit more credit, so to say. But normally people will carry it forward versus carrying it back.
Okay. Well, I think that's very useful. Has anybody else got anything else to add?
No, I mean, that's it. If that previous year's return had foreign income that you didn't have the credit to use then, that's when, as Natalie points out, that's when you use the credit. You can carry it back 1 year. You carry it back before you carry it forward.
Grand. Hugo, your turn.
Right. Okay, then one for you. Can the $112,000 foreign earned income exclusion be used irrespective of where I am resident for fees paid by non-US companies incorporated where I'm not a resident. So I guess what's not clear is whether they're resident in the US or abroad.
So if I understand this correctly, they're saying, if I live in the US, but I'm receiving income that's from overseas, can I still use the Form 2555 exclusion to reduce my foreign earned income, right? Because in some people's mind, when you think foreign income, you're just thinking income earned or that it's coming from outside of the US in some way. When we prepare a US tax return and we think about the source of income, so when we're talking in US tax terms about whether it's foreign or US income, the source for earned income, so a wage paid to you, self-employment income, the source is actually where you're sitting and generating that income. So somebody who's US based and receiving fees, receiving a salary, receiving self-employment income, they are not eligible to take the foreign earned income exclusion for a number of reasons beyond just the fact that it's not foreign earned income. But actually the earned income exclusion itself has criteria related to you being a resident outside of the US or a physical presence outside of the US. So in this case, if I understand correctly, then the exclusion cannot be used, both because you're not stateside, again, making the assumption that you're in the States, and because the income itself, while you're sitting in the States and earning, is not considered foreign earned income.
Brilliant, thank you.
Right, the next one from me, or for the team from me, is: can you use a foreign tax credit towards foreign currency gains on your mortgage?
I'm going to go with yes. It's not that simple, and I'm aware that there are different views out there as it goes. My view, I pretend I'm not representing the firm, but our view maybe is that what you have is the gain is a foreign source gain, and it's subject to ordinary income tax. I know some people have different views whether it might be a capital gain. I would be treating it as ordinary income. I would say that it doesn't fit into any of the other foreign tax credit categories and ends up in the general basket. So the issue where you're dealing with a currency gain is it's not going to be taxed in that other country, because it's the US working with their concept of functional currency. Everything has to be in dollars. If I paid off a sterling mortgage, then I haven't got any gain on that in the UK. So a gain has arisen on something that is purely that US dollar movement. So if there's foreign tax credits in the right place, you may have excess that can offset that gain, but you don't have a foreign tax credit that arises on that gain.
Thank you. There are lots of super technical questions here. Sorry. You have something to add?
No, I agree. Just thank you, because it seems so simple as a question, but it's obviously quite complicated to answer.
It's one that's debated, shall we say? But so I'm very grateful that my fellow panelists have not come at me on that one.
No. I mean, at the end, I think the principle stays the same. If you have foreign income, you can put it on 1116 foreign tax credit. The question of which bucket it goes in will depend on the situation, right? How whoever prepares your tax return interprets the rules, whether it's general or it's passive. But the main thing is, if you have foreign tax credit in that bucket, even if you're not getting foreign tax credit arising from the currency gains, as long as it sits in a bucket and you have, if it's in general and you have foreign tax credit on wages, you could benefit from the foreign tax credits on wages against that, because they're in the same bucket. So the IRS doesn't necessarily care if that income itself has foreign tax credit. They just care if it's in the right bucket, and that bucket has, enough foreign tax credit to use. So Chris, it's, depends on which bucket, but if you put it in the bucket where there's foreign tax credit, you should be able to claim.
So as a non-US person, I find that the baskets, categories, buckets, that concept that you can lump credits in from different sources of income are actually quite surprisingly generous. Most
Very
certainly
generous.
in the UK, you have to specifically identify the income that the tax was paid on. So that there's one that the US are actually helping people with to some extent.
Another foreign tax credit question is about the accrual versus paid method. What are the downsides to using the accrual method? I live in a country where the tax year is the same as the calendar year. Caitlin, do you want to have a go at that?
Sure. Well, it depends on every particular situation and how there are some cases where you're moving abroad for the first time, and the accrual method might make more sense because you have potentially a whole year of income that you're not paying tax on abroad. It varies. I don't necessarily have a particular strong opinion on which method to use. We typically use the accrual method because it more closely aligns the tax year with the tax bill, and there's less truing up to do in the actual tax preparation exercise. But I would defer to Natalie and Chris if they have a particularly strong opinion on this one.
Not necessarily. It's just once you make a certain election, you have to stick with it, right? We have seen that, people flip-flop, and then the IRS is not so happy about that. And again, it's also, in the case that you want to stay in paid and non-accrual, but you have foreign tax credits that are paid later, the carryback could be used in that case. So there's, different strategies. It really depends on what election you want to make. You just have to know that the election you make, you should stick with it. Well, and that's the IRS. There's a lot of different ways to do things. Whatever you choose, be consistent and stick with it. Don't flip-flop around.
I will chip in here on the basis that it's the UK that causes a problem here. So whilst you're on the paid basis, it's all well and good. Once you switch to the accrued, you are stuck with the accrued. Now, for most countries, and our question reference, it has the same tax year. Guess what? Most countries in the world think the calendar year is a sensible period to assess tax. But over in the UK, I believe this is because of medieval farm rents, but please don't quote me on that. We have a 5 April tax year end. And when you are
it's about it was a Benedictine calendar year. It was a monastic calendar year. I don't know why I know that.
Well, there we go. I'll add that to the knowledge base. But the problem with that is you're looking at a UK, the foreign tax that you accrue relates to a different period of income from the tax that's being reported in the US. And with just the 1 year carryback for foreign tax credits, that really can create a lot of problems. Most calendar year people, the accrued basis is much easier because that tax might not be paid for 2 years. I'm not judging Switzerland, but they don't seem too pushy on their tax collections, the speed of it. So the accrued basis works very well on a calendar year. If you're in the UK, and there are some other countries, then it creates problems. But there'll all be solutions. So you need to manage it, but you need to be aware of where you're going from one jurisdiction to another, what the accrual date is, because the IRS are very clear now. We used to maybe take different ideas as to what an accrual date was. The IRS have been very clear that it is the end of the tax year that ends in the US calendar year.
Do you have another one, Carl?
Yeah, well, I've picked this one a little because I live in France and have done for quite some time. Also, what we're trying to do, panel, is just to send you questions that are really general so that they will answer a lot of people's queries rather than something that's extremely specific. But we moved to France, which sounds very specific, but it's not. We moved to France in October and opened a French bank account. The maximum balance has never exceeded $2,500 US. Do we need to file on FBAR with our 2022 taxes?
So I can take that one. It depends on how many other foreign financial accounts you have. If that's the only foreign financial account you have and it never exceeded, 10,000 US dollars in any point during the calendar year, then no, you don't have to file an FBAR. But if you have multiple foreign financial accounts and all of them kind of have a maximum balance of about 2,000, and when you add it all up, the maximum balances, that's over 10,000, then yes, you have to file an FBAR and you have to include every single foreign financial account on it, even if that specific foreign financial account did not exceed 10,000 US dollars. Keep in mind that foreign financial accounts can include pension accounts, right? So if you have if you're employed, you have a pension account that can also be included if you open up a brokerage. So it's not just bank accounts, right? There can be a lot of other foreign financial accounts that you have in place.
So the total is the number that we need to be focusing on rather than account by account.
The combined maximum balance of all foreign financial accounts.
Thank you.
Here's one. An American living in Austria receives a portion of my husband's Swiss pension, and they have to pay Swiss tax of approximately 12%, which is automatically deductive. Will they have to pay US tax too? Previously, they'd just had earned income and claimed the foreign earned income exclusion. Caitlin?
Yeah, I'm actually looking for the question to be sure I understand it fully. But what I'm hearing is I'm a US citizen that receives pension income from a foreign country, and I'm paying foreign income tax on that pension. Can I use the 2555 exclusion? So pension income is not a earned income type for purposes of the foreign earned income exclusion, the form 2555. As a US citizen, you're subject to tax and required to report your worldwide income. So does this need to get reported to the IRS? Yes, the answer is yes. And yet when filing, instead of the 2555, you would perhaps and most likely use the form 1116, the foreign tax credit that we've talked about quite a bit already, to reduce your US tax bill related to that. Hopefully to zero, depending on the tax amount that you're paying abroad. It'll line up against the US tax rate as either higher or lower, and that'll drive your US tax bill. So in essence, you won't be double taxed. You just end up overall paying the higher tax rate between the two countries on your worldwide income in this particular situation.
Thanks.
I have another one. I'm retired, no longer contributing to any pension funds and living in the EU. How is this taxed by the IRS? Is it treated differently from other income? Not sure who wants to answer that one.
I mean, so it sounds like we're dealing with pensions in drawdown.
That seems to be.
And living in the EU, something I used to do until some strange decisions were made by members of my society some years ago, but I no longer live in the EU. That's all I can say. Living in the EU is not sufficient to answer the question because the EU does not have a double tax treaty with the US. So the specific country will dictate the tax treatment, but all tax treaties, says all as if he has read all tax treaties. I would imagine most tax treaties have pension articles, and certainly in the case of the UK one, the pension is exempted out of the saving clause that the US has. So you will not, the treaty, if there is a treaty, will normally give you the answer, and the pension piece in drawdown is normally pretty straightforward.
Thank you. Thank you. I find that very useful, actually. Well, not just because of my grey hair. I'm not yet retired, but thank you. It's very clear. Thank you.
Okay. I'm a US expat living over 40 years in the Netherlands. I report US tax married filing separately. My wife is a non-resident alien. What do I do with her foreign bank accounts for FBAR and Form 8938? Back form.
It seems like I'm getting the FBAR ones. So It depends. I mean, if they're joint bank accounts, they are going to be reported on your FBAR and your 8938, right? Because you also have signature authority, also financial interest in these accounts. But if you're married filing separately, your spouse is, not a U.S. citizen, they're not responsible for filing their own FBAR or 8938. So unless they're joint accounts, you don't report them.
Thank you. Is it my turn, Hugo?
It is.
I have a question for Chris. So says the questioner. Do you do tax prep and tax planning for Austria too? I am a German-American citizen living in Austria. Thank you.
I think all three of us could happily assist the questioner there. Foreign country is a foreign country. I think, Natalie, you're actually sat in Austria, aren't you? So, but yeah, the double tax issues, there's what we all specialise in, and I'm sure we'd all be happy to help.
Thank you. Thank you very much.
Here's one that it's probably a good question for lots of people. Is the best way for an expat living in Portugal but working for a US-based company, should they start an LLC and pay themselves in dividends while living in Portugal full-time? Or just use the W-2 as usual and have the pay deposited into an American or Portuguese bank? Caitlin, it might be your turn.
Sure. So if you are a wage earner living in Portugal, getting paid by a US company, presumably because you're receiving a W-2, I wouldn't change that. There doesn't seem to be a reason that it would make sense to set up a company, nor in the US, nor in Portugal to manage that. With the W-2 earnings, you can take the foreign earned income exclusion, potentially could use the foreign tax credit if you're paying tax in Portugal on that income. If you were to set up a foreign company, you're just tipping your toe in a world of complexities from a US tax filing requirements, actually probably making yourself ineligible for foreign tax credits if you do set up a foreign entity. And when we set up US entities, it's actually to simulate the W-2 anyway. So that's for self-employed individuals, typically is where we would set up something like an S Corp. Now, I would just stick to what you're doing. If your employer is happy to continue under the W-2 arrangement, even if you're in Portugal, then stay the course.
Thank you.
Heavens above, I have no idea how one navigates the world without tax advisors if one is a US citizen. This is super, super interesting stuff. I have another question here, I think, which any of you could probably answer. If a US person abroad invests foreign source money on an online investment platform, where are the assets on the online platform domiciled for tax purposes? In other words, which country has the right to tax the income first? Is this influenced if the online investment company issues a 1099? Does the issue of 1099 eliminate the need to report the account via FBAR or Form 8938?
So I can take that. I mean, online accounts, I mean, normally you'll kind of have a sense of where that online account is domiciled. I think every financial institution has an online account now, but if you use Morgan Stanley, that's US. If you use, a UK online platform, that's UK, right? So that's the first thing is, what financial institution are you using? If you're getting a 1099, that's most likely a US institution. I can't see why a foreign one would issue you a 1099. Some do, but normally not. And that's US regulated. So again, if it's for the question of the FBAR and A938, if it's a US, right? So like Morgan Stanley 1099, I mean, it's a US account, right? If it's a US address, you're not reporting on your FBAR 8938. Now, in terms of, where are those assets domiciled? So assets are actually, it doesn't really matter sometimes. So it depends on the assets, right? So what income you're getting. For example, if you're making dividend or interest income, it depends on the payer of the company. That is where that income is sourced. If you're having capital gains income, it depends on where you are residing when you make that capital gains income. So that's where the sourcing happens. And then that will then kind of determine who has the right source, who who has the right first taxation rights. So for example, if you have US portfolio dividends, you get 1099, usually the US will have first taxation rights. But also, I'm sure that whatever country you're living in will also want to tax that income, right? So then you can still use foreign tax credits. If you're making capital gains, normally the country you reside in will have first taxation rights, and then you can use foreign tax credits. So again, kind of two questions there, but to summarize, it depends on, you know, what online account are you using. You should have a feel of if that's a US company or a foreign company and where the assets are kind of sitting. If you have a 1099, it's most likely a US company. If it's a US company, you don't need to put it on FRA 938. And then in terms of taxation rights, it depends on the type of income you're making, whether it's dividends, interests, capital gains, etc. And from there, depending on where that's sourced, that will determine who has first taxing rights. But in the end, most likely the US and your local country will try to tax both sources of income. So you're probably going to be claiming foreign tax credits on that income if you have any available.
Well, thank you. Thank you. Anybody else have anything to add that makes that could
Natalie's absolutely covered that.
Well, I thought so too, but I was scared I'd missed something. Thank you, Natalie.
I guess the only other thing to say is if the foreign country is charging tax, gains can be calculated different, but the US has a default rule that unless you're paying 10% or greater foreign tax on a gain, then it is US source. That's straight off the bat. So
great, thank you.
Here's something a bit different. A lot has been said today about earned income. What about reporting capital gains earned in the US while living in Europe?
I'll take that one. Capital gains are actually kind of there's a unique US tax treatment. Capital gains, at least for example, holding shares of a US company and then disposing of those shares. Those shares are considered to be personal property. So they go with you where you are and where you reside. So if you're living in the EU, presumably the country that you reside in is going to want to tax that capital gain when you sell the shares. Now, unlike other types of investment income, that capital gain is going to become foreign source income because you're, in theory, sitting in the EU with those shares in your personal possession, and therefore it's a foreign source gain. So you can take the foreign tax credit based on whatever you're paying in the country that you live in to reduce your US tax bill. And that treatment does vary from the treatment of dividends and interest, which would be following the location of the company that the dividends paid from or the location of the bank account that the interest is paid from. Capital gains kind of follow you where you go.
Yeah, that's with personal property, which I think is what we're talking about here, isn't it? Shares. So real property, real estate or business gains instead of it, they're where the business and the property are. But the personal property follows you.
Thank you.
I have what I think to be an interesting question. Before expatriating, are there ways or advantages of contributing US assets with potential current or future built-in gains into a US corporation on a tax-deferred basis?
That's definitely a huge strategy question. It really depends on your specific situation. I don't think any of us can really give this blanket advice of, you know, what to do to kind of defer taxation. I can say if you're expatriating for the exit tax, I mean, at the end of the day, they don't really care about where you're putting your assets. It's about how much is your net worth at that point. And that's, you know, calculating all of your assets at that point in time. And if your net worth is over $2 million, you'll still have to be doing the exit tax, right? If it's under, and you're compliant for the 5 years, right? And assuming you're not hitting anything else on the exit tax requirements, you could, you know, just expatriate, so to say. Obviously, if you're trying to do something with tax deferral that, you know, can trigger additional filing requirements past expatriating, and you might have to still be filing Form 8854 after you expatriate. So obviously something to consider. Of course, you know, Chris or Caitlin, if you have anything to add on, you know, tax deferral strategies.
I mean, you've already said it a lot more than I would have. I just was going to say no. So you've gone a lot further than me.
Well, both answers are obviously extremely useful, I would have thought. Hugo, I think it's your turn.
Yeah. So can you explain how a PFIC is evaluated? Caitlin did speak a lot about PFICs earlier on.
PFIC is a four-letter word in the tax world, and PFICs, very, very high level, are evaluated based on the company and how the company is earning. So if the company is earning passive income within the company structure, then it's a PFIC. Now, kind of in layman's terms, a PFIC is typically coming in the form of a foreign registered mutual fund. So something that's trading, but not on US markets. That's where we most commonly see them in practice. But they can come in many different forms. And it's pooled investments that don't have financial registration in the US markets. Does anybody want to expand on the details, or is that?
I mean, that's the pain, because it's very common. ISAs in the UK, I'm sure there's equivalents all over the world. They're the standard investments that your local investment advisor will put you in, with unaware of the US issues. In fact, when someone comes to me and asks if it's the right investment advisor, I just say, go and ask them what a PFIC is. And if the investment advisor knows what a PFIC is, kind of okay. And if they don't, go, right, we need to talk. That's generally the rule. The PFIC rules have this odd rule that once a PFIC, always a PFIC. So there are exceptions for opening years, but I forget if it was Fiat or Seat, but one of the big European car manufacturers actually ended up being considered a PFIC, because the two tests of a foreign company are the income test and the asset test, which is a balance sheet test. And cash on a balance sheet can be a passive asset. And this is what, I forget if it was Fiat or Seat, but that's what they fell foul of. There was cash on the balance sheet, so technically it was a PFIC. And once a PFIC, always a PFIC.
Ah.
Yeah. So if somebody bought shares in that car manufacturer, they were having to do PFIC reporting.
Technically, I suspect so. Yeah.
Crazy. Okay. Here's one. Are there any tax advantages to buying a real estate co-ownership compared to owning?
Not that I necessarily see. I mean, at the end, if you're thinking about buying property or owning property or anything like that, you always have to, I mean, first, owning property does not trigger really anything tax-wise. I think a lot of people get nervous about buying property abroad, but buying property doesn't trigger any necessary reporting. Obviously, if you have like a new bank account to go with that mortgage, and then you have a lot of money deposited in that bank account, yeah, you might have another bank account to put onto your FR and A938. That's one consideration, but there's not really any tax when you buy property. So I wouldn't, the concern is buying property. Obviously, if you sell property or you rent out property abroad, it's the same as if you sold or rented property in the US, you have to report that income on your US tax return. At the end of the day, I see nothing wrong with just pure owning property, right? You just have to know your cost basis, understand, what your cost basis is if you end up selling it and or renting it, and then just be aware that if you rent out that property, you will, so to say, depreciate your own cost basis if you sell it one day. So not sure if that answers the question, but
I think it does, and useful kind of for other people relating to buying property. I think it is a common sort of apprehension, whether if you buy real estate in Europe, for example, there are US tax implications. So yeah, thank you.
I have one, which is, can a US expat open a new US-based brokerage account online while they are overseas? Is a US address necessary? And can a US domiciled American do the same, open the same type of account while living temporarily abroad?
Let me answer that one. Can you? Yes. There's nothing in tax law or tax legislation that would prevent you from opening an account with a foreign address or while you're living abroad, vice versa, as a US taxpayer citizen trying to open an account abroad. Now, practically speaking, it's a very, very challenging process in today's world where FATCA is costly for banks and financial institutions to comply with. And so instead of actually complying, they're just making things easy by not accepting anybody with foreign circumstances. Where we're seeing that quite frequently is with US-based IRAs and other accounts in the States. When your US financial institution finds out that you're living in France, they say, hold up, we're freezing this. You can't transact with it anymore. You need to move your account to another bank. So obviously, if somebody's been using that as a retirement vehicle for many years and suddenly they're getting the red light from their investment firm stateside, that's a big challenge to try and work through. On the flip side, we are seeing European and banks across the globe surveying their clients to say, are you a US taxpayer? Were you born in the States? Do you have a US tax filing requirement? And as soon as you say yes to that, they're also shutting their doors to opening up an account, which is making it very, very challenging. They say, give us your social security number. Imagine getting a letter from your French bank for asking for your US social security number, right? That's a surprise, especially if you've not realized you had to file US taxes in the first place. But not all Americans have social security numbers, which is another challenge to then overcome once the bank is demanding this information from you. So can you? Yes. Is it challenging to do so? Absolutely. And it will become more and more so, but there are a few platforms that are facilitating just knowing that the world is kind of going international, and there is quite a demand for international banking services that can support people like all of you. So,
very good point. Very good point.
Yeah, here's one. I'm a US citizen who is a temporary resident in Mexico, where I work remotely for a US-based company. All of my financial accounts are in the USA. My permanent address is in the USA, but I spent less than 330 days in the USA in 2022. Will I qualify for exemptions and credits? Who'd like to take that?
I can grab that one. I mean, I think the main question is actually the last part of the question is you need to spend more 330 full days outside the US. So even if you didn't spend that in the US, that's kind of the question. But if you are mainly abroad and you are 330 full days outside the US for a consecutive 12-month period, that does not need to be January to December 31st. It can be any 12-month period as long as it starts or ends in the tax year. Then you may be able to use the foreign earned income exclusion using the physical presence test, right? If you are, it seems like you're mostly domiciled in the US, you're kind of just being abroad. And if you're not technically registered in, Mexico or wherever you are, and you're not paying taxes there, then there's no foreign tax credit to claim because you have to actually pay foreign taxes to have credit to claim. So really, you're just looking at the foreign earned income exclusion. I would tell you to track your travel on a spreadsheet. Make sure you are not, make sure you're abroad for enough time. And if you're abroad for enough time, again, in this consecutive 12-month period, and you pass the physical presence test on Form 2555, you can definitely use that for any income that you earn outside of the US. Again, remember, it's about where you're sitting. So if you work inside the US for, 10 days, that 10 days that you earned income, you have to calculate how much income you earned in those 10 days. And that amount cannot be excluded on the foreign earned income exclusion because that's US sourced at that point.
I guess it depends how temporary the assignment is. We don't have that information. I was also wondering if someone, not me, was going to, I just heard Mexico and thought that's commuterville, isn't it? So Canada and Mexico, you have commuting in and out. So that's a whole other area that I would not comment on. Though actually our Michigan lot see quite a lot of Canadians commuting in and out. But not an area I'm too confident.
Yeah, I think the question just comes down to, are you really, 330 full days outside of the US, right? Full day, not commuting, but you're really spending the majority of your time outside. Again, the physical presence test is pretty generous in that regard, that you don't have to necessarily be registered in a foreign country. That's the bona fide residence test. So that's I would say the biggest thing for you is just make sure that you're 330 full days outside the US in a 12-month period. And then you can try to use the foreign earned income exclusion, just keeping in mind that you might not be eligible for the full exclusion amount if your 12-month period was not the full tax year, because then it kind of gets prorated. But I'm getting a little bit too technical here. So look for 2555, look for the physical presence test, and if you meet those conditions, then you can use it.
Hugo, can I go? I've got a question here from, may I go? I am a US and French citizen, double citizenship.
I'm getting suspicious about these French questions that keep coming up.
Yeah.
Getting a bit suspicious.
Vous parlez pas français, monsieur? I'm a US and French citizen who will be living full-time in France next year. It's a question, by the way, for you, Caitlin. I will need to file both French and US taxes. I'm interested in using a US expat tax service like Bright Tax. But how does that work with filing French taxes? Do the US services help me file French taxes too? If not, how do they advise that I file French taxes? Are there other companies that help with US expats filing French taxes?
Good question. So I think that there are a wide variety of companies out there in the world that you can utilize to file US expat taxes, whether that be a brick and mortar firm that you go to locally. And just speaking to Bright Tax in particular, we specialize in US expat tax filing. We have a partner network that we rely on to collaborate with, in this case, a French tax professional who can support both filing in the US and on the French side of things. So I think that US taxation is a very, very broad and extensive topic that I would never try and venture into a foreign tax system and try and be an expert there too. There are people out there that do both. They're hard to come by, but they do exist. And yet the best thing that we can offer, at least as a firm, is the ability for us to collaborate with professionals that we trust and rely on and know in France, and facilitate the exercise, collaborate to set up the most appropriate and most tax efficient approach for you. Whether you're filing the US tax return first, the French tax return first, depends a lot on your personal circumstances and the nature of your income. And the timing would need to be adjusted based on what the source of your income is and where we're going to be using the foreign tax credits on the US side, on the French side, et cetera. But again, there's a wide range of services out there that can provide different things and have different strengths. And I can speak to our own.
Thank you, Caitlin. Thank you. And just to confirm, yes, there are firms in France that can help US people file in France. So, yeah, but thank you very much. It's very useful.
Okay, here's one. I'm an expat teacher. I lived in Dubai from Jan to July, and then Boston from July to December. How do I differentiate that? They say, should I just do my taxes from Jan to July and regard the rest of the year when claiming credits? I don't imagine that's possible. Who'd like to comment on that situation?
So we don't know the story of what happened the year before. So I don't know if the Dubai sojourn was longer than those first 6 months, in which case, as the panel touched on, that we'd probably be, and if you were in Dubai, you probably would be looking to have claimed the exclusion if you qualified it under the physical presence, as Natalie was explaining. So because in Dubai, you haven't got a local tax rate. What your US tax return, ignoring the prior year, what your US tax return for the year of return, the half in Dubai, half in Boston, essentially your wages, you'll report everything. You report the whole calendar year, worldwide income, whatever that your FBAR 8938 FATCA, whatever, you report everything for the calendar year. Half of your income, because half of the year, would be foreign sourced, sitting in the general category we would imagine for foreign tax credit purposes. The question is then, have you got any foreign taxes? Before Dubai, were you somewhere where you built up excess foreign tax credits that you've carried forward? You're winning if that's the case. You're winning because you didn't pay to Dubai, but the US will relieve you from double tax. They're not giving you a free hit on Dubai. You're paying US tax on that if you haven't paid tax anywhere else. Those excess carry forwards might save the day if you built them up in the 10 years preceding.
We're coming up to the hour. Karen, have you got one more?
I have, but I'm not quite sure if we're going to get it done in a minute, but let's go for it. I will be getting married this year to a Swiss citizen and move there. I presume that the question, the person who's posing the question is American. If I am not working, do I just file a regular US return? I do earn some income from US brokerage accounts. Also, if and when I have to pay Swiss taxes, can I claim for a foreign tax credit? I hear that the Swiss have a wealth tax. So would the FTC apply?
Not a 30-second one, as you say.
But I can. Oh,
go on. That I was going to say it's not a 30-second story, let alone a 30-second answer.
Yeah. I will try my best. So first thing, congrats on getting married. If you're married to a non-US citizen, you're probably married filing separately, right? That's number one. So you can file your tax return without them. The next question, even if you're not working, you're telling me that you earn income from US brokerages. If you make over $5, you got to file a US tax return because the filing threshold for married filing separately is $5. Even though your standard deduction is the same as single at $12,950, your filing threshold as married filing separately since 2018 is $5. So if you make more than $5 from interest from your US banks, US brokerages, you got to file a US tax return. Now, when we're talking about claiming Swiss foreign tax credits, wealth tax is very debatable. I think every firm has, their own interpretation on whether wealth tax can be considered a foreign tax credit, if it should be itemized, if it can be seen as passive foreign tax credits. I will not answer that in 30 seconds. What I will say is if you have income and you're making income in Switzerland and you're taxed on that income, you can of course claim foreign tax credits on it. So that is my very quick answer to that.